Okay, portfolio management is the topic and we have 36 questions on agenda. Question number 1. A firm is considering a new investment project that will involve building a large office block. The firm's financial analysis department has estimated that the proposed investment has the following estimated rate of returns distribution, meaning thereby that this project can earn 20% return, it is 20% probable, 10% return, it is 50% probable, and there is a possibility of loss also, and the loss could be 5%, and the possibility of loss is 30%. If the question requires you find the expected rate of return, it's a very simple question. You will simply have to multiply these returns with their corresponding probabilities and add your result, and that is all, simply. So what I'm going to do, I'm going to write -5% on my calculator, -5 is 30%, plus 10% is 50%, plus 20% is 20%. So I've simply multiplied these returns with their probabilities and added the result. It gives me 7.5%. This 7.5% is the expected rate of return. Those who have done part 1, I'm sure they know how to find the expected value. Question is a very simple one. Next. The state of economy has strong effect on expected returns as shown below. Yes, state of economy, if it is good, you will earn more. If the state of economy is bad, you will incur losses. If the economy is in recession, which is 35% probable, in that case, the stock returns will be negative, of course, loss. If the economy is expected to be stable, in that case, which is 40% probable, your returns would be 10%. And if the economy is in expansionary phase, which is sometimes called as economic boom, which is 25% probable, in that case, your stock returns could be 30%. Now, I want to calculate an average return, neither too good nor too bad. I just want to have an average value for my returns. So what is the expected rate of return? The same mechanism that we followed in the previous question. You will multiply these probabilities with the returns. 35% 10% plus 40% times 10% plus 25% times. This is in fact weighted average of your returns with regard to probability. So it's 0.35 times -10, don't forget that, plus 0.40 times 10% and 0.25 times 30%. What you get is 8%. So it means neither too good nor too bad. On average, I can expect a return that is around 8%. It may not actually turn up. It is not possible to have an exact 8% return. It is just an average. That is what we can expect the return to be. So expected rate of return is 8%. It's quite similar to what we have done in part 1 in expected value analysis. Question number 3. An optimal portfolio of investment. Let us go back to the slides and let me tell you what is an optimal portfolio, so you have a better idea. Okay, an efficient portfolio, which is not the question's requirement. An efficient portfolio is among those feasible portfolios. What is an efficient portfolio? That gives you the highest return for a given risk, earns you the highest return for a given risk, or that gets you the lowest risk for a given return, or offers the least risk for a given expected return. That's what we're looking for. This is efficient portfolio. We are looking for optimal portfolio. What is optimal portfolio? Optimal portfolio is one of those efficient portfolios that is selected from efficient portfolios that is tangent to the investor's highest indifference curve. What is the highest indifference curve? This one. This is the highest indifference curve offering the highest level of utility. So optimal portfolio is selected amongst the portfolios on the highest utility curve. This curve has the highest return for a given risk, and for a given return it has the minimum risk. So the return somewhere here that is offering the highest level of return for a given level of risk at the highest indifference curve is called the optimal portfolio, and that's exactly what is needed in the question. It says, what is an optimal portfolio of an investment? An optimal portfolio of investment is not any portfolio. Efficient because it offers the highest expected return for a given risk. An optimal portfolio, collection investment, is tangent to the investor's highest indifference curve. Why highest? Because this indifference curve offers the highest utility for any given level of risk. So the correct description, if you just need to know the theory behind the optimal portfolio of an investment is tangent to the investor's highest indifference curve. When you say tangent, this is your highest indifference curve. Any line that just touches this curve at one point, in mathematics this is called as tangent. So at that particular point, the return and risk are brought in comparison. This is the given risk and this is the expected return at that point. And extending this idea further, this is a tangent as well. It is tangent at this point, and at this point the standard deviation is comparatively higher and the return is even higher. So every portfolio collection within the highest indifference curve represents an optimal portfolio. So D is the right answer. Moving on to the next question. At the beginning of the year, a portfolio manager who manages a portfolio, what is portfolio? Collection of investment. So a portfolio manager who manages a portfolio with a mean annual return of 8%, okay, an annual standard deviation of 25%, all right, and wants to estimate the worst case expected loss at 80% confidence level. Okay, we haven't read anything like that in the theory. So where does this come from? The value of portfolio, blah, 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 fine. Now what this is all about, let me take you back to the slide. So what is value at risk? It's in unit 1, which we haven't yet done. We have started from unit 4, 5, and we are currently in unit 4, started from unit 2, 3, and now we are in 4. So value at risk basically is a statistical technique to quantify risk. It's a way to measure risk. We will not be required on the CMA exam to apply this statistical model on computations. We just have to be familiar that it's a way to quantify your gain or loss. It is used primarily on 3 different types of situations. What could be the maximum profit or loss at any point in time? 1. Second, what could be the minimum and maximum NPV of the project? And what could be the minimum and maximum cash flows for an organization? Estimated at certain level of confidence and measured with certain level of statistical precision. So that's what we need to know about VAR and nothing else. That's what you need to know about VAR. Learning outcome statement is very explicit on it, that the students are expected to know what is value at risk. That's all. And computations are not required. This is explicitly mentioned in parentheses within your learning outcome statements. So taking this idea and applying this on the given question. At the beginning of the year, a portfolio manager who manages the company's investment portfolio with a mean annual return 8%, I don't care what it is. Annual standard deviation 25%, okay, so what? Wants to estimate the worst case expected loss at 80% confidence level. What this paragraph or this sentence is telling me that they are going to use standard deviation, mean returns, and a confidence level. These are the indications of value at risk. So the value of the portfolio today is 5 million. Okay, fine. Which method would the portfolio manager use to estimate the probable maximum loss, maximum gain, maximum cash inflow, maximum or minimum net present value of the project that may be incurred at the end of the year? It's value at risk. D. Arbitrage pricing theory was a part of your syllabus about a couple of years ago. It is no longer in your book. Excluded. Capital asset pricing model we discussed in the lecture yesterday, as well as covariance. And of course, B and C cannot be the answer. Next. For a firm engaged in risk management, value at risk is defined as what? What is value at risk? Maximum loss, maximum value a company can lose. Partly correct. Maximum loss within a certain time period. Yes. Year or 6 months or quarter at a given level of confidence. 80%, 95%, 99%. So this is the definition of value at risk. It's a way of statistically calculating maximum loss or gain within a certain time period at a certain given level of confidence, and that's what you need to know. And it's applied on maximum to determine the maximum minimum loss or gain, cash maximum minimum, or the net present value maximum and minimum with a certain level of confidence. That's what you need to know about the value at risk. Here we go. A market analyst has estimated the equity beta for a company to be 1.4. Beta, not beta, beta, okay? It's 1.4. This beta implies that the companies, we have discussed much more in detail that beta can have three possible values: 1, less than 1, and greater than 1. Beta 1 means the specific company's shares return are closely correlated with the market. If the market goes up by 10%, the return on this specific asset goes up by 10% as well. If the market goes down by 10%, the return on your specific share will go down by 10% as well. That is exactly in line with the market. Beta of less than 1 means if the market goes up by 10%, your assets return would go up by something less than 10%, let's say 3%. And if the market goes down by 10%, your returns will fall, but comparatively to a lower extent. Why? Because your stock is comparatively stubborn. It doesn't move exactly in line with the stock market return. Beta is greater than 1 means if the market goes up by 10%, your shares return will skyrocket. Why? Because it is more sensitive to the market. If the market goes down by 10%, your return will plummet to the ground. Meaning thereby having beta greater than 1 means that the returns are more sensitive to the market returns. So I would say this moves exactly with line in the market. This is comparatively less risky. Why? Because it is comparatively stubborn in movement in upward and downward. Less risky. And the last one where beta is greater than 1, it means it is more volatile. More volatility means more risk. So it is riskier, more risky. So that's the idea. Since 1.4, beta is greater than 1. So this beta implies that the company's systematic risk is lower than the market. No. Systematic risk, the risk of the whole market, is higher than that of the market portfolio. Correct. It is more volatile than the market portfolio, the market as a whole. So beta is greater than 1. Next, a measure that describes the risk of an investment project relative to other investments. A measure that describes the risk of an investment project or an asset or a certain share relative to other investments in general is beta coefficient. If you remember, we do not need to memorize the formula. The actual formula to calculate, this is not a part of your syllabus, by the way. It is calculated by covariance of the return on the asset and the return on the market divided by the variance of the returns on assets times variance of the return on the market. And this formula is not in your syllabus. You won't be using it, but you can see it's a comparative measure. It's a relative risk. So measure that describes the risk of an investment project relative to the other investments in general is beta coefficient. Standard deviation is for a particular single asset. The variability of return in a single asset is standard deviation. Expected return is an average return expected from a certain asset. So clearly, when we measure the risk of one asset with respect to the market, it has to be beta coefficient, that is B. Next question, comparatively a fuller question. Let's see what it has here. DQZ Telecom is considering a project for the upcoming year that will cost $50 million. Fine. DQZ plans to use the following combination of debt and equity to finance the investment. Okay. First, we need 50 million. So out of this $15 million will come from 20-year bond at a price of 101 with a coupon rate of 8%, flotation cost of 2%. Fine. This is the detail of bond issue. The remaining 35 million would come from retained earnings. The equity market, so 15 plus 35, we are done. 50 million is there. What exactly do we need? The equity market is expected to earn 12%. Equity market is expected to earn 12%. Without doubt, we got one of the variables. This is the expected return on market called RM. US Treasury bonds are currently yielding 5%. It's a risk-free rate, which means you face no risk if you make such an investment in treasury bonds, you're sure to get 5%. The beta coefficient of DQZ is estimated to be 0.6. This is beta that we'll be using capital asset pricing model, 0.60. DQZ is subject to an effective corporation tax rate of 40%. Fine. What exactly do we need? The capital asset pricing model, CAPM, computes the expected return on a security by adding the risk-free rate, we know that, to the incremental yield of the expected market return, which is adjusted by the company's beta. This in fact is a description of the whole CAPM formula. RF is equal to beta times return on the market minus risk-free rate. And this is what you call the expected return on the particular asset. If you read the statement, reconcile the words with the symbols in the formula. The capital asset pricing model computes the expected return on a security, yes. How? By adding the risk-free rate, yes. To what? To the incremental yield. This is incremental yield, RM minus RF, which is called the market risk premium. So, risk-free rate plus incremental yield adjusted by the company's beta. So basically, what is expected return under the CAPM? It is the addition of risk-free rate plus the market return, which is called the market premium, adjusted for that particular asset, for that particular project. This is what you call ER. We have got all what we needed. Risk-free rate is 5%, beta is 0.60, return on the market is 12%, and the risk-free rate is 5%. You just simply compute it, you will get your expected return under CAPM. So it's going to be 12 minus 5 times 0.6 plus 5, and it gives you a nice 9.2% that matches perfectly with your option A, and A it is. Next, question 9. Using the capital asset pricing model, find the required rate of return for a firm with a beta of 1.25. Let us just mark down what we have been given. We have been given beta, that is 1.25, comparatively riskier than the market. So beta is 1.25 and the market return is 14%, RM. And when the risk-free rate is 6%, there is nothing in this question, Faisal, as you were discussing yesterday. You won't be requiring to calculate beta. You just have to learn how to use it. So you just plug it in the CAPM formula and you will get your expected return. So expected return is risk-free rate, that is 6%, plus beta, that is 1.25, times the difference of the return on market and the free risk rate, which is also called the risk premium. So it's 14 minus 6%, that is 8 times 1.25, and to this you add your risk-free rate, it's 16%. That matches perfectly with your option D, and D it is. Next. Okay, an analyst of a common stock estimates the following information for the next year. Expected return on the market portfolio is 12%. See, there is a consistency in questions now. This 12% represents RM. Expected return on the treasury stock, RF. Expected beta of the particular stock or the asset is 2.2, that is B, beta. Using the CAPM, the analyst's estimates of next year's risk premium for the stock. Guys, I need attention. Next year's risk premium for the stock. We discussed two things yesterday. One is what you call the risk premium. When you say just the risk premium, it means RM minus RF. That's simply risk premium, and that is the difference between the return expected on the market minus the expected return on treasury stock. Unfortunately, that's not the answer. Apparently 7%, but that's why. Because it didn't ask for the market risk premium or just risk premium. It says, Zuhaibji, it says the analyst estimated the next year's risk premium for the stock. So it is not risk premium or the market risk premium. It is basically that specific assets risk premium, that particular stock risk premium. When you particular stock, particular asset risk premium, it has to be adjusted for beta. So it's going to be beta times RM minus RF. So you have to be very careful on the exam because 7% is there, but that unfortunately is the incorrect answer. See, Zuhaib, this is how he kills us on the exam. Beta is given, that is 2.2. Return on the market is 12% Risk-free rate is 5% because he's very specific. Risk premium for the stock. So it's an asset risk premium that has to be adjusted for beta. 12 minus 5, 7 times 2.2, and it gives me 15.4, and that's your answer C, and C it is. Right? Next. So be very careful. Do not jump to the conclusions unless you have very solid grounds for your selection. The return on two stock can be correlated in values except those that are. The question is, as I told you, 60 to 70% of your part 2 would be based upon theoretical questions. So do not take them lightly. Make sure you understand each and every bit of it. The return on two stocks, A and B, can be correlated in values except those that are either two stocks A and B are positively correlated. If they are, R would be positive 1 or between 0. The number would be something not 0, in fact some positive number like 0.3 to plus 1. The number will be in the positive range. If A and B are negatively correlated, R would be somewhere between negative 1 to some number near to 0 with a negative sign, right? And if A and B are unrelated, then R would be an exact 0. So yes, two stocks can be positively correlated. They can be negatively correlated. They might not have any correlation at all. So here you're right, except skewed. This is a nonsense term. It has no meaning whatsoever in the given context. A and B can either be positively correlated, negatively, neutral, not skewed. It's a nonsense concept in the context. This is no term for use in correlation and regression. Next question. Here we go. A company is considering investing in two of the following securities. Either we can invest in A and earn 14% return with a beta of 1, moves exactly with the market. We can invest in B that earns 8% and it has a beta of negative 1. Now this is interesting. We have seen that either we see beta to be exactly equal to 1, that moves exactly in line with the market. We have seen beta to be either less than 1 or the beta that is greater than 1. So, speaking mathematically, when you say greater than 1, meaning this has to be on the positive side. When it is less than 1, it means either it can be in points or it can be negative. So let's just try to understand this negative beta, because this is the only question you would see the beta to be negative. And what does this negative mean? The beta negative 1 means that if the market goes up by 10%, the return on your asset goes down exactly by 10%. It moves exactly in opposite direction to the market. And if the return on the market goes down by 10%, the return on that asset go up by 10%. So it moves exactly in opposite to the overall market. This negative 1 signifies the situation like this. Here we go. So here we need to diversify. Zishan isn't here today. When we need to diversify, we have to combine those investments that are negatively correlated in order to maximize the impact of diversification. That would result in maximum reduction of risk. So which two securities combination would best limit the risk? C has beta 0. It is totally unrelated with the market. So we will not be able to diversify by introducing C in our portfolio. So what we can do, look at A. 50% of A and 50% of B. Since these are opposite and correlated to the market, this 1 and negative 1 will neutralize the impact of each other returns. Hence you will get a consistent return because they have negative correlation. So having 50% of A in your portfolio and 50% of B will reduce the risk to the maximum level. A and C, since A has 1 and C is not related to the market, it won't reduce the risk. We have discussed and we have convinced ourselves that the risk reduction is maximum if the investment portfolio components are negatively correlated, and that is only possible in A. Next. Which of the following would have the least, mind the word, these words totally twist the question altogether. Least. These are sometimes called the question twisters. Which of the following would have the least impact on the firm's beta? Remember, beta is a measure of risk. And how we calculate the risk? Beta is the measure of the return, the volatility of the return on your asset as a comparator to the return on the market. How the market returns change and correspondingly how your asset returns are changing. This is measured by beta. So basically it's a measure of risk. Which of the following would have the least impact on the firm's beta? Debt to equity ratio. If debt and equity ratio change, the risk changes. So yes, Faisal, you're absolutely right, Faisal. Spot on. If the debt to equity ratio change, the risk will change. Hence, this will affect the risk. If the industry characteristics change, the risk would change. So B would also affect beta. Operating leverage, which in fact is a measure to what extent the fixed asset, the fixed cost, like rent, like insurance premium. So operating leverage is a measure that in your cost composition, what is the proportion of the cost that is fixed which you have to pay. Rent and insurance, since you have to pay these costs, this makes business leveraged and it increases your risk. There is also another concept of financial leverage. Operating leverage means fixed cost as a proportion of total cost. And there is also another concept, financial leverage. Financial leverage means you take loan from the bank at interest rates. So the interest payment is a compulsory payment. You have to make the payment even if you are incurring losses. So fixed cost is a compulsory payment, mandatory payment. Interest expense is also mandatory payment. So if the company has higher fixed costs, we will say the company has a high operating leverage. If the company has taken loans on which the company will have to pay interest, we can say that the company has high financial leverage. And of course, they are the determinants of risk. So it means A, B, C are the measures of risk. Beta would depend upon A and B and C. But look at option D. Faisal, you're right. Payout ratio. Payout ratio means if the company earns 100, out of which the company has paid 60 as dividends, so we can say the payout ratio to be 60%. Payout ratio simply can be calculated that how much you have paid dividend per share upon how much you have earned earning per share. So it can also be calculated by total dividend paid divided by total earnings for the current period. So either you take on per share basis or you take total dividend by total earnings or dividend per share or earning per share. So this is what you call the payout ratio. It has no relationship with the risk at all because it's simply how much of the cash is being paid out of the earning. So it's not something that will affect your risk. A, B and C will. Next. Here we go. The betas are expected. These are the betas 1.4, 0.8, 1.5 and expected returns 12, 11 and 13 for three investments being considered are given below. Fine. The return on the market is 11%, which we know to be RM, and the risk-free rate is 6%, that is we know RF. If the capital asset pricing model, this is the only model you have. There are other models as well, from a French model, arbitrage pricing theory. They are studied in CFA. There was a little bit introduction in your CMA part 2 about a couple of years ago, but they have been excluded. So you have just this CAPM model and the equation that we're discussing. So the return on the market, RM, and the risk-free rate, RF. If the capital asset pricing model is used for calculating the required rate of return, which investment should the management make? Okay. The question is, should we decide on ER, expected return, or should we decide on beta? This is a question that you need to deliberate upon. That when we need to make a decision in which of these investments should we take. Return is the factor, no doubt about that. Return is considered. But what is the management or the investor's attitude to risk? We have seen that there are three types of investors: risk averse, risk seeking, and risk neutral. The question is silent. So either we can calculate ER for all of these projects, ER for project A, B and C. And I think he has calculated them all. We don't need to calculate. They are there, 12, 11 and 13. But this expected return is not the simple factor to decide what we should be doing. Look at the betas here. Beta 1.4 for A is comparatively more riskier. Beta for investment B is 0.8 and C for 1.5. Okay. Now let's say if I select B for which beta is 0.8, 11% is the expected return. Let us calculate ER for each of them separately. This is the expected return, what the firm is expected, but what the ER is expected from these projects separately. It can be calculated for each one separately. For EA, risk-free rate is 6%, beta is 1.4, risk premium is the difference between RM and RF, that is 5%. So I think I'll get a different answer. Then it will confirm my hypothesis. 5 into 1.4 plus 6% is 13%. See, but here we have 12%. It means this is what the company wants, but as per the risk profile of this project, the expected return should be 13, not 12. Let us calculate for B. Risk-free rate is 6%, beta is 0.8, premium is the same, that every time, 11 minus 6%. 11 minus 6% is 5%. If you solve this all, 0.8 times 5 plus 6, see, 10%. Let us calculate for the last one as well. Expected return as per the given data, as per CAPM, C, 6% plus beta, that is 1.5, times the difference between the risk-free rate and the market rate, again 5%. So it's going to be 1.5 times 5 plus 6 gives you 13.5. Now compare these results with the results given in this column. From investment A, we're expecting 12, but as per the risk profile, it has to generate 13% in order to be profitable. So since our desired return is 12, but for this project to be worthwhile, it has to be 13%, which means it doesn't meet the criteria. For B, expected return, as we need 11%, but this project, as per the risk profile, is offering a return of 10%. It's not the return that the project will generate, this is the return that the project will generate. But this, as per the risk specific of B, beta 0.8, and the risk premium, it is 10%. And for C as well, the expected return by the company is 13%. But since the risk is comparatively higher, the risk should be, and risk adjusted return should be 13.5%. So among these all, we are expecting 11% return from the project B, but as per the risk, even 10% is sufficient for this project. So it means out of these given situations, B appears to be the best option. Not only it has the lowest beta, but overall the return, keeping in mind the risk, is 10%, whereas the desired rate is 11%. So it means it has to be B. You can see the detailed description. If there is any option remains, see there, here we go. Investment required rate is 13%, expected is 12. For only investment B, the required rate of return is 10%, but the project is generating 11%, which means this project is generating more return than our expectations, so we should accept it. So do not leave out on this valuable information. Sometimes the idea could be a little hazy, but if you read the fuller description, you will get a finer understanding. Moving on to the next question. Question number 15. A stock has an expected return of 16%, that is ER, expected return 16, using the capital asset pricing model. If the expected return on the market is 12%, which is RM, and the risk-free rate is 4%, which is RF, what is the beta coefficient? You simply have to plug these numbers in the formula. We know that ER is equal to risk-free rate, that is 4%, beta, which we do not know, return on the market is 12%, risk rate is 4%. ER is already given, 16. You can plug 16 here. So 16 is equal to 4% plus beta, 12 minus 4 is 8%. So 16 minus 4 is 12%. Rest is simple arithmetic. So beta is equal to 12 upon 8%. Percentage sign would be cancelled out. You get a simple fractional answer, 12 by 8, and it is 1.5. So here we're right. B is the answer. See, it was simple arithmetic. You just need to plug in the right numbers. So using the capital asset pricing model, determine the expected market risk premium. Guys, attention. Attention, attention, attention. Determine the expected market risk premium, period. Which means I'm looking for return on the market minus risk-free rate. This is what you call the market risk premium, and it is calculated by deducting your risk-free rate from the expected return on the market. No, it's a return on investment. We have to solve it. Yes. So we need basically RM minus RF, this factor, and ER is not. We have not been given the RM. This isn't there. We have to determine it. We have the formula: expected return is equal to risk-free rate plus beta. Return on the market minus risk-free rate. Expected return is 7.4, risk-free rate is 3%, beta is 1.4, RM minus RF. We don't need to input any number. Why? Because we need exactly this arrangement, RM minus RF, which is in fact the market risk premium. Don't simplify this any further. Keep RM minus RF as the subject of your equation and keep it as a block and solve this for as it is. So 7.4 less 3, it will give you 4.4. So 4.4 is equal to 1.4 times RM minus RF, which in fact is my requirement, which I'm enclosed in a block. So it's going to be 4.4 upon 1.4 and gives me 3.14%. And that is RM minus RF. Do not simplify it any further because we need exactly this arrangement, which represents the market risk premium, and it's A. A is the answer. But let's say if the question required that you need to find the asset risk premium, for that we have to multiply this value, which is RM minus RF 3.14. We had to multiply it with beta 1.4. So remember, RM minus RF is the market risk premium, but beta times of RM minus RF is called the asset risk premium, or in other words, the risk premium adjusted for a particular asset. So moving on to the question number 17. Okay. Stock A and stock B are combined into an equally weighted portfolio. Fine. Equally weighted portfolio means we have two assets in our portfolio, A and B, and weightage is like this. We have 50% of A and we have 50% of B in our asset investment. Fine. What exactly do we need? If stock A has a standard deviation of return of 30%, standard deviation for A is 30%, okay, and standard deviation B, which I can write as SDB, is also 30%. Fine. And the two portfolio of the stock has a standard deviation of returns of 30%, and the portfolio of the two stock a combined standard deviation of 30%. What is the correlation coefficient of the return between the two stocks? Now you would be scratching your head, what exactly is the formula that we have to apply here? What we have yesterday, CAPM, we studied in detail. We studied only what is coefficient of correlation. There was no formula, not needed. Beta, the formula I gave you for beta was a very simple one. The beta formula that you should be using in CMA exam is the change in returns of the asset or the project or the share divided by the percentage change in return of the market as a whole. This is the formula that you should be using in CMA, but I'm sure you remember the formula that we use conventionally in ACC and CA. It's covariance of the asset and the market divided by the variance of the market and the asset. Of course not. This is not what you're expected to use. We'll be using this one. Fine. And then one more formula we studied, if you remember. That is covariance. Covariance. What is covariance? Covariance is the coefficient of correlation of an asset of A and B multiplied by the standard deviation of A multiplied by the standard deviation of B. Right. Now what we have been given, we need to find R. That is, what is the coefficient of correlation? R is to be calculated just from this formula. Otherwise the value of R itself is calculated by a long tedious statistical computation which is beyond the scope of your part 2 syllabus. So let us plug in what we have so far. We have the standard deviation of A that is given as 30%. If 30% is removed, it's 0.30. R is there as well. Standard deviation of B is already given as 30. That is given as 0.30. Now what do we have? Do we have covariance? Read this information again. And the portfolio of the two stock has a standard deviation of return of 30%. Remember guys, if the standard deviation is squared, it becomes variance. So covariance means the combined variance of A and B. In other words, it is the square of the standard deviation combined of A and B. Remember, covariance means the combined variance of A and B. In fact, is the square of the standard deviation of A and B, and that has already been given to you. It's already been given to you as 0.30. This. So plug this 0.30, which is the standard deviation of A and B combined. We need to take its variance, and remember, variance is the square of standard deviation. R is to be calculated. 0.3 times 0.3, again it will become 0.3 whole square. If you can make R the subject of this equation, it becomes perfectly 1. It means these two stocks A and B are perfectly positively correlated with the value 1, and that's your answer D. Next, the systematic risk. I'm sure you remember there are two types of risk. Systematic risk is the risk of the whole market that is not in control, that cannot be diversified, and unsystematic risk is the company specific risk that can be diversified by disposing of that investment or that particular share. The systematic risk of an individual security is measured by the standard deviation of the security's rate of return. No, the standard deviation of a single share in fact measure the risk of that particular share, which you call the systematic risk. Remember, the standard deviation. Let's say if I have a share A and I have the return of these shares over the last 10 years. If I calculate the spread of these returns over the last 10 years, it will give me the standard deviation of this particular A as a return, standard deviation of asset A. Basically, this is unsystematic risk, company specific risk. It is company specific risk. I am talking about the systematic risk, the risk of an asset as a comparator, as a relative risk compared to the risk of the whole market. This is not true, not a correct statement. Then what is systematic risk? Systematic risk of an asset is measured by the covariance between the securities returns and the general market. That's the perfect description of the systematic risk, which can be further understood by this formula, which we are not expected to use. The covariance of the asset and the market combined divided by the variance of the return on the asset times the variance of the return on the market. Compare this beta, which is a measure of systematic risk, with B. So basically it's a covariance between the security returns and the general market, mean the volatility of return of that particular asset with regard to the whole market. This is the measure of systematic risk, or the measure of beta, which measures what? It measures the volatility of a particular asset's returns with regard to the whole market in which we are operating. When you talk about the whole market in which we are operating, that is the system in which we are operating. So you are measuring the risk of the system, systematic risk. So that is B. Alright, moving on. If two projects are completely, positively, linearly dependent, if two projects, two investments, two shares are completely and positively linearly dependent, it means their returns can be plotted this way. And we know the measure of correlation coefficient in that case will be exactly +1. That is C. Let's say the question had asked A and B are completely and negatively linearly dependent. We would have got something like this. And in that case, R would have been perfectly -1. Since they are positively linearly dependent, so that means C has to be the right answer. Moving on. Which of the following specifically measures the volatility of returns? Attention. Which of the following specifically measures the volatility of returns together with their correlation with the returns of other securities. Since it is talking about the return to dependent returns, variance is either for a single stock or for a group of stock. This question is specifically asking which of the following specifically measures the volatility, which is a measure of risk, by the way, of returns together with their correlation are with the returns of other securities. So you have two securities. They might be positively correlated, negatively correlated, or uncorrelated. So which of these variants determine, or which of these formulas, in fact, which of these formulas determine the returns of these two assets combined, considering the coefficient of correlation between them? We've just done that. Covariance is equal to the coefficient of correlation multiplied by the standard deviation of returns of A, which is volatility of returns of A, multiply the standard deviation of B, which in fact is the volatility of returns in B. This is the formula for covariance. Read this formula and correlate it with the theory given. Let's do it again. Which of the following specifically measures the volatility of returns together with their correlation with the returns of other securities in two stock portfolio? In your syllabus, you just have two stock portfolio A and B, so it would be measured with covariance, that is given as D. In your previous book, and I'm sure you would have watched the lecture as well, coefficient of variation was included. It is there in the lecture, but in the new book he has excluded, he has removed coefficient of variation. It's not science as such. Just I would like to add this within the recordings. We know variance. Variance is the square of standard deviation of any return on any asset. So variance is the square of standard deviation. Standard deviation we already know is a measure of volatility. Covariance we just see there's a formula given. Covariance is the coefficient of correlation multiplied by standard deviation of asset A in the portfolio, standard deviation of asset B in the portfolio. Coefficient of variation, which is not in your new book, it is equal to coefficient of variance is equal to standard deviation of a particular asset A divided by the expected return on asset A. So please note down this formula. Has been excluded from your new book. It was there in the old book. Probably we have a couple of questions on this formula, so we might need it. So standard deviation as a measure of expected return is called covariance. What exactly it means? Let me just try to explain this formula. We have understood all the formula CAPM. We discussed this formula yesterday in detail, right? We discussed standard deviation in detail. We discussed variance in detail. This hasn't been discussed. So let's discuss it a bit. Covariance, coefficient of variation. In fact, no covariance. It's covariance. This is coefficient of variation. It's different. Coefficient of variation is standard deviation of a particular asset divided by the expected return on that particular asset. Okay. I have calculated the standard deviation of asset A. What is standard deviation? Volatility of returns. Risk in that the deviation of return in that particular. Let's say is 70. Just any number. And I have calculated the expected return for this asset to be, let's say, $30 in dollar terms. What this number tells me now, 70 by 30. We try to understand the idea. 70 by 30. It comes out to be 2.3 per $1. What does it mean? It means for this asset A, $1 return will make me face a risk of 2.33 without unit. Standard deviation doesn't have any unit. It means that in order to earn $1 return of asset A, I will have to face standard deviation of 2.33. Comparatively speaking, I have another asset with me that for which coefficient of variation is 4 per $1. What does it mean now? For company A, for every $1, I will have to face a standard deviation of 2.33. But for company B, in order to earn $1 of return for this company, I will have to face a standard deviation of 4, which means for every single dollar, I am facing less standard deviation here and more standard deviation here. So comparatively speaking, I would go for investment A because it is offering less volatility. This is no longer a part of your syllabus anymore, but it's a very valuable measure. You might see a couple of questions on this, maybe a few questions onward. Let's see what we have next. Here we go. Based on the following information about stock price increases and decreases, make an estimate of the stock beta. Faisal, specifically for you, we do not have to calculate beta. We just have to estimate it. We just have to assess it. Like, look at this. You are talking about a particular stock S. This stock went up 1.5% when market went up by only 1.1%. Fine. In another instance, in August, your stock went up by 2%, whereas the market return went up by 1.4% only. And in September, when the market fell, your stock fell by 2.5%, when the market fell by only 2%, which means your stock is relatively more volatile than the return on the market. Even if we don't have to calculate it, it's quite apparent it is greater than 1. Why? Because when the market rose by 1 your share went up by 1.5. When market fell by -2, your stock fell by 2.5, negative. It means the beta is greater than 1. And let's say if you apply my formula for any of these three numbers, not my formula, it has been given in your book, the rough estimation of beta, instead of using a complicated formula, it is the change in returns on the asset on the change in return of the whole markets. So take any combination, take this one for example. So asset returns have increased by 2%, whereas market for 1.4%. Clearly the result is greater than 1 in any of these cases. So you get A to be the correct answer, and A it is. Next. This is a good question. More mathematics than financial management. Alright. Question 22. Stock J has a beta of 1.2. Let's write it as beta J. And an expected return of 15.6 ER. Stock K has a beta of 0.8, that is beta K, and expected return of 12.4. Okay, it's ER. What is the expected return of the market? We need to find RM, which isn't given clearly, and we have to find the risk free. It's a very good question. In fact, not the examinable one, but it's a good question to test your basic mathematics skills, basic algebra. So we have two stocks given, stock J and stock K. We have to apply the same formula for both and then solve these two equations simultaneously. We know the expected return is equal to risk-free rate plus beta times return on the market minus risk-free rate. ER for J has been given as 15.6%. Risk-free rate isn't given. Beta is given for this 1.2. Return on the market isn't given. Risk-free rate isn't given either. Let's simplify this equation as far as practical. 15.6% is equal to RF. 1.2 times RM gives you 1.2 RM. And 1.2 times RF gives you 1.2 RF. Right? If you simplify, it will give you 15.6% is equal to 1.2 RM. RF minus 1.2 RF gives you negative 0.2 RF. So your basic maths would always be there, even in your professional studies. For K, we are going to apply the same formula. Expected return for K is given as 12.4% is equal to risk-free rate, which isn't given. Beta is given as 0.8. Return on the market, no. Risk-free rate, no. Which means 12.4% is equal to RF. 0.8 times RM means gives you 0.8 RM. You have no justification whatsoever for leaving out on any question in line. You have to do each and every question. Even a question like this, you have to do it. 0.8 times RF Now we have two equations. Let us simplify this one first. 12.4% RF minus 0.0 RF gives you 0.2 RF positive and 0.8 RM. Now we have two equations and we have to solve them simultaneously. This is equation 1. This is equation 2. So either you take equation 1, make RM or RF the subject of the equation, plug that number in your equation 2, or do the same thing from 2 to 1. Your choice. So let's say I'm going to take my equation 1 and make RF the subject of the equation. It will give me 0.2 RF. Here substitution. If you take 0.2 RF as the subject of the equation, it will be 1.2 RM minus 15.6%. So if you take RF as the subject of the equation, 0.2 would divide the whole of this equation. So 1.2 divided by 0.2 will give you 6 RM. 15.6 divided by 0.2 gives me 78%. This is the value of RF. If I plug this RF in this equation, I can find RM, and if I just get RM, I'll get the final answer, possibly. So here we go. It's 12.4% is equal to 0.8 RM, which stays there the same, plus 0.2 times RF. RF has just been calculated as 6 RM minus 78%. Let me plug the charger. Here we go. So it's 12.4% is equal to 0.8 RM. 0.2 times 6 RM, it will give you 1.2 RM. And 0.2 into 78% gives you 15.6%. See, 0.8 RM and 1.2 RM gives you 2 RM. And 15.6 taken to the other side will give you 12.4 plus 15.6. It's 28%. That implies RM is equal to 28 by 2, 14%, which makes either C or D to be the correct option. It means we have to solve it for risk-free rate as well. So since we have found RM, simply plug this RM in this equation, you will directly get RF straight away without any further substitution. So RF is equal to 6 times RM, which is 14% less 78%. So 14 times 6 less 78 gives you a nice percentage, 6%. No, 6 times 14 less 78, it's 6%. Okay, here we go. We have A as well. See, A has 14% market return, we have it, and A has 6% risk-free rate, that is RF. So it perfectly matches with your option A, and option A it is. See, it's a long question, but we test more of your basic mathematical skills rather than any area of financial management. Moving on to question number 23. If the return on the market portfolio is 10%, that is RM, and the risk-free rate is 5%, that is RF, what is the effect on the company's required rate of return on its stock of an increase in the beta coefficient from 1.2 to 1.5? Great question. Very good question indeed. RM is given, RF is given. If the beta changes from 1.2 to 1.5, how would it change your ER, expected return? So it's very simple. We will do the calculation first. ER for the given values. Risk-free rate is 5%. Beta is 1.2. Return on the market is 10%. Risk-free rate is 5%. If you solve this all directly, 10 minus 5 times 1.2 plus 5 gives me 11%. So existing ER is 11%. So without solving, we can guess that since the beta is going up, ER would go up. Would go up, it means either A or B. Let us be sure to by what percentage ER would increase. Simply plug in the new data. Risk-free rate stays the same. Beta has gone up by 1.5. Risk premium is 10 minus 5%. So it's going to be 1.5 times 5 plus 5 is going to be 12.5. So when the beta goes up from 1.2 to 1.5, expected return goes up from 11 to 12.5, thereby registering an increase of 1.5%, and it perfectly matches with the option B. B it is. Next. Question 24, 12 more questions to go. It says that the common stock has a beta coefficient of 1.7. Fine. The following information about overall market condition is available. Expected return on US Treasury bonds 6%. If it doesn't say so, we know for sure that this is risk-free rate. Expected return on the market portfolio is 8.5, that is RM. Beta is 1.7. Using the CAPM model, what is the risk premium on the market, guys? Risk premium on the market, risk premium on the market, which means what we need is RM minus RF. Risk premium on the market, not the company's specific risk. That would simply attach beta to it. So simply write the formula down. ER is equal to RF plus beta times return on the market minus risk-free rate. ER is given. Have we been given? No. Expected return on the market is given 8.5. I don't think we need any calculation at all. We just need these two things, and I think they have been given. Yes, they have been given. Return on the market is given. We don't need to apply the formula. We just need to calculate RM minus RF. Plug the numbers, you'll get your answer. RM is 8.5% and RF is 6%. So the difference between these two, which is 2.5%, represents your market risk premium, and that's C. But if the question requires that what is the company's specific risk premium or the risk premium for the company, so you will have to use this formula, beta times the return on the market minus risk-free rate. So this would change the result to 2.5 times beta, which is 1.7. So it's 2.5 times 1.7, 4.23, see, 4.25. So the both of these results are given, so you have to be very clear on this, that whether the risk premium on the market is needed or whether the asset risk premium is needed. This is the formula for asset risk premium, and this is the formula for simply the market risk premium. So we got the idea. Moving on to question number 25. If the firm has a beta value of 1, what does it mean? It means the return on this asset are perfectly positively correlated with the market return. So if the beta is 1, the expected return on this asset should approximate the overall market, and that's C. It is not risk-free. Price is not relatively stable because it is 1, it has more movability and there is volatility. We can't say there is no volatility or low volatility. Next question. Question number 26, 10 more questions to go. A mature firm is operating in a very stable market. Okay. Earnings growth has averaged about 3.2%. Earnings are growing at this percentage for the last dozen years, for the last 12 years, just staying in line with inflation. So earnings are increasing in accordance with to inflation. So the firm's weighted average cost of capital is 8%. We will discuss it in detail later. We have those who have done unit 2 and 3, they know what it means. Weighted average cost of capital is the aggregate cost of various funds that the company employs. So the weighted average cost of capital for this company, the overall cost of funds this company is using, is 8%, which is much lower than the most firms. So this company is maintaining funds at an optimal level where the cost of funds is only 8%. The new CEO wants to turn what he calls a cash cow, the company that generate more cash like Microsoft, into a growth company like Apple. So he wants to switch a firm like Microsoft, which is a cash cow generating a lot of money, into a company that is growing rapidly, like Apple Incorporated. That's the idea. The CEO wants to reduce the dividend payout into the stars. Atif, yes. It's a growth company into a star. So cash cow into a star. The CEO wants to reduce the dividends payout. He wants to pay less dividend to the shareholder and use the resulted retained earnings to fund the firm's expansion into new product lines. And this is what will result in converting this cow into a star. The firm's historical beta has been 0.6, which is very low. It means the company is quite stubborn. It's quite less risky compared to the whole market. With the CEO's changes, what will most likely happen to the firm's beta and the required return on investment in its shares? Now, this is interesting. The CEO is planning to switch into a market where he's going to introduce new product lines. He wants to convert this cash cow, which is, remember, the cash cow is less risky business, because without taking risk, the company is generating good deal of cash. Like Microsoft, you don't see so many ads of Microsoft on TV or on the internet, because it's a very stable company generating regular, consistent cash flows. So when you're trying to convert a cash cow like Microsoft into an Apple, you need to bring in new products that might prove to be risky. They might not be sold. So the risk of the company would go up, which means the beta would rise. Since you are introducing new products, that can result in risk for the company. So beta is going to rise. That is either C or D. Right. Since the beta is going to go up, we know the formula ER is equal to risk-free rate plus beta times return on the market minus risk-free rate. Since everything stays the same, RF stays the same, RM stays the same, RF stays the same. If the beta goes up by introduction of new product lines, there is absolutely no doubt that the ER will rise as well. That means D is the right answer. If the beta goes up, rest stays the same, the required return will go up. So that makes D to be the correct option. Next question. In the context of capital asset pricing model, CAPM, the beta coefficient of a stock that has the same systematic risk as the market as a whole. So beta for a company that has the same systematic risk as the whole market is C1. If beta for a certain asset is 1, it means this company has same volatility of returns as does the whole market portfolio or the whole market as a whole. All right. Question 28. The difference between the required rate of return on a given risky investment and that on a riskless investment with the same expected utility is what? The difference between the required rate of return on a given risky investment and that on a riskless investment with the same expected utility. See, the statement is not making sense. Let's just write it down. When you write things down, things start to make sense. It isn't making sense as of yet. The difference between the required market rate of return, which we call RM, since it's the difference, it means minus, and that on a riskless investment, RF. What is it called? See, now it makes much more sense. The difference between the risk-free rate and the return on the market is simply called the risk premium or the market risk premium. If you attach beta with it, it will be the company specific risk premium or the asset risk premium. Next. Question 29. An investor is considering the purchase of one of two common stocks. Okay, question number 29. An investor is considering the purchase of one of the two common stocks. Fine. The projected returns for the two stocks and the probabilities for each are listed below. ये जनाब Mercel company है. This company is generating possible returns of 6, 4, 2 and -2 with these probabilities. Another company, Gilbert company, could have these possible returns with this probability. What exactly do we need? Based on an expected rate of return calculation, just expected rate of return, which stock should the investor purchase? Fine. What we need to calculate? We need to calculate the expected return for these two companies. So what I'm going to do, I'm going to keep one percentage sign intact and convert this into decimal. This is what you do. So I'm going to take 6 multiplied by 0.1 plus 4 multiplied by 0.40 plus 2 multiplied by 0.40 minus 2 multiplied by 0.10. It gives me 2.8%. So it means the average return or the weighted average return or the expected return, which is the weighted average, for Mercer company is 2.8%. Doing the same thing for Gilbert company, I'm going to keep this percentage sign and convert this into decimal, all of these, so you get the result in percentage. 7 times 0.25 plus 5 times 0.25, 0, no need to do that, minus 1 times 0.25, what you get is 2.75%. So the expected return on Gilbert is 2.7. So Mercer companies is marginally better, 2.8 versus 2.75. So Mercer company is preferable because its expected return is slightly higher. That's the reason we select Mercer, because the returns are higher, even slightly, but still higher. Next question. It says the term beta can be best described as, we have so far read two formulas. One that is given in the book, that is recommended for CMA students, that is the change in returns on assets divided by the percentage return on the market portfolio or the market as a whole. And beta, as per the original formula, is the covariance of the asset and the market, square of the variance, square of the standard deviation of assets and the variance of the market. Now let us compare variability or standard deviation of investment returns. We don't see standard deviation here, and moreover, beta is a comparative risk of asset return compared to the return on the market, not for a single asset. It's a comparative measure. That's why A is not the right answer. B, investment return sensitivity to changes in the market's return. Yes, sensitivity of the return on the market compared to the sensitivity of the return on the market as a whole, as per the formula we have read in the book. So that makes perfectly the correct description of what the beta is. Next. It says an analyst uses the capital asset pricing model to measure the required return on two stocks, stock X, stock Y. The expected market rate of return is 12%, that is RM. Risk-free rate is 4%, that is RF. The beta is 0.5 for X and 2 for Y. So very simple, you just have to calculate ER. I'm going to directly plug the formula. Risk-free rate is 4%. Beta is 0.5. Risk premium is the difference between risk-free rate and the market rate, that is 8%. So I'm going to get the straight answer is going to be exact 8%. For stock Y, ER is equal to 4%, beta is 2, risk premium is 8%, so it's going to be 20%. So 8% X versus 20% for Y. So it was just a repetition of what we have been doing so far. Next question. A company uses the coefficient of variation. See, it has been excluded from your book and still there's a question hanging around. Coefficient of variation, I told you. Coefficient of variation, please note it down. You never know what the examiner can do. You may need to check your learning outcomes. Coefficient of variation is the standard deviation for a particular company A divided by the expected returns of that particular company A. That's what you call the coefficient of variance. It is not covariance, it's coefficient of variation. Entirely different measure. So company uses coefficient of variation to compare the returns and risks of the project. The expected returns and standard deviation of returns for the Opal project and the Pearl project are given below. Let us calculate for both. Coefficient of variation for Opal, O. expected returns are 10% and standard deviation is 40. If you simplify, what you get is 4:1. So what does it mean? For every $1 earning, I have to face a risk of 4 without any number. You do the same thing with the Pearl. Coefficient of variation of Pearl is equal to standard. That's what you get, the expected return, that is 12, and the standard deviation, that is 54. So 54 by 12, it is 4.5. So it's 4.5 ratio $1. Now comparatively speaking, for Opal, for every $1 return, the risk is 4. For Pearl, for every $1 return, you will have to face a risk of 4.5. So that makes Pearl to be risky, Opal to be comparatively better option. So the company would most likely judge the riskier project to be Pearl. So Pearl with coefficient of variation of 0.22, not 0.22 in fact, the coefficient of variation of 4.5, that perfectly matches with your option B, and B it is. Next, we're just closing. Based on the assumptions of the capital asset pricing model, the risk premium on investment with a beta of 0.5 guys, it means this particular asset has a comparatively less risk than the market. So what could be the right option then? Again, based on the assumption of the capital asset pricing model, the risk premium on an investment with a beta of 0.5 is equal to risk-free rate? Absolutely no. 0.5 means still it has a risk, but comparatively low risk than the market. So it is clearly not risk-free. The risk premium on the market would only be possible if the beta is exactly 1. Twice the risk premium on the market, that will be case if the beta is 2 times the market. Half the risk premium on the market, that is perfectly fine. Beta, since it's equal to 0.5, which in fact means 1 by 2, and 1 by 2 of what? RM minus RF. And what is RM minus RF? It is what you call the market risk premium. So basically, if the beta is 0.5, it means the asset risk premium is half or 50% of the market risk premium. Perfect mathematical harmony, and D is the right answer. Next. Question says, using the capital asset pricing model, an analyst has calculated an expected risk-adjusted return of 16%. Has calculated an expected risk-adjusted return of 7%. That is ER. ER has already been calculated. That is the end result of the capital asset pricing model. The company stock has a beta of 2. Okay, and the overall expected market return for equities is 10%. That is RM. The risk-free rate is 3. Okay, everything is given. Everything is given. What exactly do we need? Do we need any computation? All else being equal, the expected risk-adjusted return for the company stock would increase. Expected risk-adjusted return depends upon risk-free rate. It depends upon beta. It depends upon return on the market. It depends upon risk-free rate. It says everything stays the same. If the risk-free return decreases, here, then this market risk premium, RM minus RF, this would increase. Look at this. RF currently is 3%, right? If it falls to 1%, let me plug the number. Let us calculate the existing return. That is 70% already given. Let us say if the risk-free rate falls from 3% to 1%. Let us see what happens. Plug risk-free rate 1%, beta 2, mind it. Return on the market, it is given as 10%. Risk-free rate is only 1% now. Let us see what is the result now. 10 minus 1, 9. 9 times 2, 18 plus 1. It is 19%. See, when the risk-free rate decreases from 3% to 1%, your ER, which was 17 originally, has gone up to 19%. Without doubt, it's A. Right? You just plug the numbers, you got the answer. You could have done it without the formula. Just look at this. If RF falls, the differential, whatever comes, will be multiplied by beta, which is 2. So this 2 multiplied by larger number will increase the expected return. So that's why if the RF falls, the ER goes up. Question 35. Which of the following calculations does not employ statistical techniques such as normal distribution? I told you normal distribution or value at risk is used for cash flows, for earning distributions, for net present values. So the value at risk model is applicable on A, on B, on C as well. Capital adequacy is entirely different concept. Capital adequacy means that a firm or a financial institution has sufficient funds that it can not only honor the demand of the account holders, but at the same time it can lend to new fund seekers. So a financial institution is strong enough financially that not only it will honor the demands of its account holders, but still it will have sufficient funds to lend money to the new fund seekers. So this clearly is not something that we calculate using statistical model of value at risk. We use these ABC under value at risk, but not D, and that's why D is the right answer. Last question, and then we are done. A firm has been growing at a rate of 10% per year and expects this growth to continue. This is the question of the day. The best question so far. Last, guys, but not the least. A firm has been growing at a rate of 8%. This growth rate is termed as G in the Gordon growth model and expects this growth to continue and produce earnings per share of 4. Earning per share is expected to be 4. Amazing, beautiful question. The firm has dividend payout ratio of 35. If company earns 100, 35 is paid out as dividend. This is what you call the payout ratio. Out of 100, 35 is paid as dividends, which is called the payout ratio. And beta is 1.25, fine. Risk-free rate is 7%, good. And the return on the market is 15%, fine. What is the expected current market value of the firm's common stock? Amazing. It's not a single step question. We have been given a plethora of various values and we haven't yet decided what to do with these numbers, where to start from. We need the current market price. Okay. Current market price. For current market price, we have only studied the Gordon growth model. And Gordon growth model, if you remember, says that expected return on the market is equal to dividend paid next year upon current market price plus growth. That's the Gordon growth model. So we do not have ER, we do not have D1, we do not have P0. That's what is needed. In fact, P0 represents the current price. And the only thing we have is the growth rate. It means we cannot directly employ this formula. We have to find D1, we have to find ER, only then. So one thing we can do, for ER we can employ the capital asset pricing model, and we have all the ingredients we need for the capital asset pricing model. Plug in the numbers, you get one of the variables. Risk-free rate is given as, where? 7. Beta is given as 1.25. The return on the market is given as 15. And risk-free rate is 7%. See, so one of the elements of the Gordon growth model has been determined. 15 minus 7 times 1.25 plus 7 gives me 17%. So one of the elements is there. Yet I do not have D1. ER is there. I found out this. So let us just cancel this cross now. We have got this one. All right. We have to find D1. D1 is the dividend that we are going to pay next. It says that the company is going to earn $4 next year, and company intends to pay 35% of this amount as a dividend next year, which means the dividend next year is going to be 35% of your earnings. If you earn $4 per share, 35% of this would be given as a dividend. So it's going to be 35 times 0.35 times 4, 1.4. So it means the next year dividend is going to be $1.4. We are done. All done. Plug the numbers. ER, expected return on the market. We've calculated expected return on the asset is 17%. Dividend that is going to be paid next year is 1.4. Current share price, that is what we need to determine, and growth rate is given as 10%. Let us bring this into decimal system. 17% means 0.17, 1.4 upon P naught, and this 10 means 0.1. Okay, so if you take 0.1 to this side, it will be 0.1 less 0.17. It gives you 0.17 minus 0.1, simply 0.07. So 1.4 upon P naught. So making P naught the subject of this equation here, P naught is equal to 1.4 upon 0.07. 1.4 was 0.07. It gives you $20. It means the current share price of this company is going to be $20. An amazing question that brings three things together: the capital asset pricing model, the payout ratio, that is the stock market ratios, and the golden block model. So try to grip on question like these. You will have more diversity, the more skill of managing diverse questions. So guys, that ends your portfolio management MCQs area completely. All the questions have been done, and so I'm going to close this recording now.